We are all going to learn how to raise funds from international markets. So let's begin with one of the most significant concept, that is euro issues. Euro issue is a name which is termed as one of the sources of finance and refers to a capital available to raise money outside the home country in a foreign currency, that is exactly called euro issue. This is one of the most common term used in the money terms or the economic terms, which is available outside the home country in foreign currency. And under this particular issues, the most common source of fund that are American depository receipts, global depository receipts, and the foreign currency convertible bond. These three are the most common used source of funds where the investors, companies, or the organization can easily raise the funds from outside the country in the foreign currency by following its own you can say set up guidelines, and accordingly they could do you can say they can do a particular transactions outside the country in foreign currencies. So this is how the euro issue, one of the most significant name or one of the source of finance, is always be an important economic or finance concept which has been you can say among the others issues categories. Let's talk about the features of euro issue. The first one is the international capital rising. As I told, the euro issues always allow the Indian companies, they can access the global capital market, they can expand their funding sources from outside the India in foreign currencies. So automatically it will useful when the domestic capital is insufficient. So if any of the Indian company is facing any financial shortages, or there is a shortage in the financial resources, then automatically they can use this one of the source of finance, that's called euro issue. So they can easily access the foreign currencies, which could be a beneficial to Indian companies. Next one is the foreign currency denomination. The securities are issued and denominated in the fairly convertible foreign currencies such as US dollars or the Canadian dollars or the Australian dollars. So this allows the Indian companies to raise their funds in a foreign currency, which could be stable and convenient for their international operations or for their international you can say working operations in outside the country. Next one is the listing on foreign stock exchange, and the Indian companies who are actually issuing the euro issues, or which termed as a securities in terms of shares. So it could exist in one or more foreign stock exchanges like the New York Stock Exchange or the London Stock Exchange, and this could also ensure the company global visibility and provides the liquidity to the international investors. So if any of the Indian companies is issuing shares and just dealing with outside the country in foreign currencies, then definitely they have an advantage to be listed in a you can say outside country stock exchanges like a New York Stock Exchange or the London Stock Exchange as well. Now we can come up to the advantages of euro issues. So rising funds by way of euro issue acts as a cheap source of foreign currencies funds for a company without exchanging any sort of risk, especially for those companies who have a foreign currencies receivables. In case of finding a way of equity, debt equity ratios or debt services covering ratios wouldn't be an issue. The company can also easily use these tools, use these ratios if they are finding any funding by way of equity as well. Company can also easily gain an international exposure. They can easily gain a knowledge about what would be the process to liquidate, you can say, for their shares. Euro issue provides a larger market and how they can get an international access to funds. So this is also one of the advantage of the euro issue, whether it would be an Indian companies where they deal with the foreign currencies, or when they can able to raise the funds in foreign currencies so that they can easily operate into an international operations. So and at the same time they can also provide a larger market and international access to funds as well through dealing with the foreign currencies through the shares. So they may also lead a larger volume fundings, but which is somehow it would be difficult from the foreign sources as well, especially when it comes to India. So it would be difficult for the domestic sources in India. So it opens up new opportunities for the companies in new markets as well. Let's talk about the disadvantages of euro issues. So as euro issues have merits and demerits as well, so there are also disadvantages of such concept. So through the euro issues are usually available at the lower cost. So somehow the companies may do not have any adequate receivables or so that they can run a currency exchange risk. So automatically exchange, you can see currency exchange risk, one of the risks which always exist if the companies do not have an adequate funds to be received in foreign currencies. So as a result, it would be a riskier for the companies, whether it would be an Indian company. So and may have to incur the hedging cost, protection cost, the exchange risk cost, that how they could protect themselves from such risk, and it could be a disadvantage from them if they don't have adequate funds to be received in foreign currencies. So as a result, and of course a hedging cost, a protection tool cost could be a turnout would be more and more expensive rather than to save the cost. So this is also the one of the disadvantage of it. Not all companies can avail funds, so it's not be necessary that every company who enters into international access or international operations which and just raise the capital from outside the country. So it's not necessary every company would get involved in it. So all the companies, not necessary that all the companies get involved to issue, you can say, to avail funds through the euro issues like shares, and the company has to follow the guidelines which has been set up by the Reserve Bank of India. So it's not necessary that every company could follow such guidelines or strict guidelines. So at the same time, there is also a setup criteria to avail the funding through this route, where while following the guidelines of the RBI. So this is also the one of the disadvantage which could be suitable for the few Indian companies, which could not be suitable for the other companies as well. Companies may have to undergo a stake dilution. So if they raised through the equity shares or convertible bonds, so they have to be a very strict guidelines if they have raised money or funds through equity or convertible bonds. So this is also the one of the limitation of the euro issue. Let's take an example, a few theoretical examples over to understand the euro issue. The government of India have been permitting Indian companies to issue equity. It could be HDFC, you can say Securities Limited Company. It could be IDBI Securities Limited. So the government of India has also issued such companies like to issue equity or equity related instrument to international investors in the form of global depository receipts and convertible bonds. As detailed notification has also been issued on November 12, 1993, it's outlining the scheme for the issue of foreign currency convertible bonds at say FCCB and ordinary shares through depository receipt mechanism route. So this notification is also being given that such schemes outline the scheme which could be issued about these bonds as well, and the companies are also eligible to you can say to issue such bond schemes to the international investors. The next important concept is depository receipt. What is exactly the depository receipt is? The depository receipt is a negotiable instrument which is being issued by a bank so that they can represent the shares in a foreign public company, which allow investors to trade in the global market. So it's a type of instrument which always allow the investors or the companies to trade in the global market, and that is exactly called the depository receipt. Depository receipt is also allow the investors to invest in companies in a foreign country. So as it allow the investor to trade in the global market, then definitely it also allow the investor to invest in companies who are in the foreign countries. So while trading into a local stock exchange in the investor home country, so rather than they focus on the domestically invest money into the home country being as an investor, so rather than they invest in companies who are exist in the foreign countries, and if any of the investment done in the foreign countries, it becomes depository receipt. It could be a very beneficial to the investors since shares are not allowed to have a for home country, then they trade in a domestic country. So they have a various opportunities in terms of trading in the global market, and that actually called depository receipt. Depository receipts were created. Why it is created? To minimize the complications of investing in foreign securities. So this is such sort of receipt. It is a protection mechanism which has been created to minimize the complication or the complexities in trading by investors in the global market. The creation of the depository receipt, it's also eliminate the entire process, and it makes it very simple process and more convenient for all those investors who are willing or who are actually able or interesting to invest in the international companies. How are depository receipts issued? An investor needs to contact a broker. So there are a series of the steps that how the depository receipts could be issued. So first is an investor who is willing to invest, he or she has to contact a broker into a local bank, and if or she is interested in purchasing a depository receipt. the local bank in the investor home country. Let's say if I want to invest and I'm in India, so I can contact any of the broker of any of the broker in a local bank. So I could visit, if I talk about HDFC Bank, this is a local bank as in India for me. So I could contact a broker in such bank, and I could coordinate and willing to show an interest in purchasing the depository receipts. So the local bank in investor home country, which is called a depository bank. So if I am visiting or through a broker in the local bank, say in HDFC, so the HDFC is a depository bank in my home country, that's called India. So the local bank in the investor home country, which is called a depository bank, will access the foreign security before making any decision to purchase shares. So they have to access every foreign security, every foreign mechanism, foreign guidelines. Accordingly, they could take any decisions upon it. So the broker in the depository bank will purchase the share. Either on the next is then when they accept the decision, then the broker in such depository bank, that's called a local bank of the home country, will purchase the share either on the local stock exchange that it trades, or purchase the shares in the foreign stock exchange by using the another broker in the foreign bank, which is known as the custodian bank. So here we are talking about the broker who is in a depository bank. Now they will purchase the share either in the local stock exchange, so that they can trade and purchase the shares in the foreign stock exchange by using the another broker in the foreign bank. So now there is the two main step. So the broker who has buy the shares or purchase the shares either on the local stock exchange, they can trade, they can sell, they can purchase the shares also in the foreign stock exchange by using the another broker in the foreign bank. So if you are in India and you are using a local bank, so I am the one who can purchase, who can sell, who can trade, and who can find out for another broker in the foreign bank if I am willing to buy, trade the securities in the foreign stock exchanges. And that this whole process is called the custodian bank. So if I come to the foreign bank, in other words, I could say it is called the custodian bank as well. So it's a very simple words where you need to understand. So if I'm the local and a broker is a depository bank, just purchases the shares, then they can sell, trade and buy shares in the foreign stock exchange and by another broker, by using another broker only. So any local broker cannot deal with the foreign stock exchange. Even they have to use the another broker who are dealing with the foreign bank. If then you can easily trade into a foreign stock exchange. So this is how the step by step the process goes on and deal with it. So after purchasing the shares, okay, fine, you have used the another broker in the foreign bank, and you have purchased the shares in the foreign stock exchange. Now after purchasing the shares, the depository bank will request the shares to be delivered to the custodian bank. So if you have used another broker in the foreign bank, you can say bank, and by using another broker, then it becomes a custodian bank. So automatically after purchasing the shares from the foreign bank, so the depository bank will request to the custodian bank the shares to be delivered. So after the custodian bank receive the shares, they will group the shares into the packets, and each consists of 10 shares. So now the custodian, what is the role of the custodian bank? Then they will receive the shares and they will group that shares into a packets, and each consists of 10 shares, and each packet will be issued to the depository bank as a depository receipt, which is traded on the bank local exchange. So the foreign bank, what will they do? They receive the shares and they will grouping the shares into the packets, and say a 10 shares each, a 10 packets. Then they deliver to the local you can see bank, local depository bank, and accordingly they could trade into a local stock exchange. So this is how the simple process goes on, where the first role is the depository bank, then the local depository bank, then the local stock exchange, the foreign stock exchange, then it becomes the foreign bank using another broker, it becomes the custodian bank, then custodian bank, then the local bank requests to the custodian bank the shares to be delivered, and then the custodian bank will receive a request or receive the shares, then it group into the packets, and which consist of 10 shares, and accordingly they will issue to the local depository bank. As I said in the beginning, which is if I'm in the home country like in India, and HDFC is a depository bank or the local depository bank, then the custodian bank has delivered the shares to the local depository bank, and the local depository bank will trade such shares to the bank local stock exchanges, local stock exchanges that the bank is dealing with it. So this is how the small step could work in your you can say benefit. So when the depository bank receive the depository receipts from the custodian bank, it notify the broker who will deliver it to the investor, and the debit fees from the investor account, and debit the fees, whatever the deliver fees or you can say holding fees or holding charges from the investor account, or any other taxes, charges or taxes, fees as well, it from the investor account. So this is how the process, these 6 steps will be followed, and then you will receive a depository receipts. Advantages of a depository receipts. Exposure to international security. Any investor who is willing or able to invest, they can easily, and when they diversify their investment portfolio, a bundle of investment that he or she could done into different international securities like shares, equity, or any other convertible bonds, by gaining an exposure, and through which they can gain an exposure to the international securities, and of course in addition to stock offered by local companies. So if you are dealing with international securities, and when you reach that country, the local a company could also offer the securities to you as well. So this is also the one of the advantage of the depository receipts. Second one is additional sources of capital. The depository receipts provides the international companies a way to show a way to raise more and more capital through the depository receipts, or by tapping into a global markets, or entered into a global markets and attract the foreign investors around the world. So they can also, as the local companies also offers the securities in the foreign countries, then definitely they can raise the capital to enter to a global market, and they could also benefit to all the foreign investors around the world. Next is less international regulation. So since it is traded on the local stock exchanges, investors do not need to worry about international trading policies and global laws. So if you are doing any investment or you are trading in a local stock exchange, you don't need to worry about the laws, about the trading policies or global laws. So but the investor will be investing in a company in a foreign country. They have to follow they have to follow in some of the corporate rights, being able to be bounded of you can say directors. So this is how when you talk about the global laws, the trading laws of the local companies in the foreign country, so of course the investor are bounded of the you can say directors by the board of directors. And of course, and once they will invest into a you can say in a companies in a foreign country, so they will also have a vote to rights. They will also be as a member you can say to vote in a you can say for a board of directors as well. So this is also the one of the advantage of the depository receipts as well. Next is disadvantages of depository receipts. The first one is the higher authority and processing fees and taxes. That's very true. This is also the one of the one of the biggest disadvantage. The higher administrative and taxes, processing charges, taxes will be charged, so that they can compensate the custodial services from the custodian bank as well, which leads to a higher taxes. For example, American deposit receipts receive the same capital gains and dividend taxes as other stocks in the US. So the investor is subject to of course it is deals with the foreign currencies transactions like shares. So automatically they have to bear the taxes or the regulations like aside from the regular taxes in the US. So they have to bear a high taxes rather than paying any regular taxes in the US as well. So this is a case of the one of the example of the American depository receipts. So instead of paying any regular taxes in the US, they have to bear up the high capital you can say dividend taxes, which is on the same rates as considered as a regular tax rates for the investors. Greater risk from the foreign exchange rate fluctuation. That's true. It called a currency exchange rate would be the higher when there is any currency foreign exchange rate. So if the investors purchases any depository receipt that represents shares in a British company, its value will be affected by the exchange rate between the British pound and the currency in the buyer home country like India. So this is called one of the fluctuation, a huge fluctuation rate between the currencies exchange rates between the you can say the United Kingdom and India. So it is in pounds and rupees. So somehow the when we talk about the depository receipts which represent shares in the British company, so definitely its value would also be affected by the currency exchange rate between the United Kingdom and India. Next is limited access for most investors. Sometimes depository receipts may not be listed in the stock exchange, but there are few institutional investors or the only institutional investors which are companies or organizations. They can execute their trades on behalf of clients. They can also invest in them as well. So this is also the one of the disadvantage of the depository receipt, that only the companies or institutional investors, where the companies, the organization also involved, they can also trade on behalf of the clients, which is a very you can say a riskier and a disadvantage of the depository receipts. This is the examples of the depository receipts. Standard Chartered Banks open its you can say Indian depository receipts offering to Indian investors on May 25, 2010, and the Indian depository receipts open at the Bombay Stock Exchange and the National Stock Exchange on June 11, 2010. So these are the example where the local bank is also open up the depository receipt. They are issuing the depository receipt to the Indian investors who are members of the companies or the institutions. They have such depository receipts have also opened to the Bombay Stock Exchange or a National Stock Exchange as well with effect to 2010. Eligibility. It is also important to know the eligibility of the depository receipt. Companies and investors should know a certain eligibility details and the key consideration before you enter into an Indian depository receipts. Firstly, to issue Indian depository receipt, a company must be listed on the Indian Stock Exchange. So if you want any Indian depository receipt and bank could able to issue, then your company must be listed on an Indian Stock Exchange. It could fulfill all the applicable laws and regulations, and additionally the company must have a track record of profitability in a year and must not be in default of any regulatory requirements. Another critical consideration is also the minimum subscription requirement, which is where the minimum number of shares that must be subscribed by a single investor, and the requirement is also differs from each company and is determined by factors such as the company market capitalization value and the price of the underlying shares. So definitely that it also depends upon the minimum number of shares, that how much the investors could buy or could trade a minimum number of shares, and which also differs for each company as well, and also determined by the various factors too. So it is important for the investors to carefully review these eligibility details and key consideration before deciding to invest in an Indian depository receipt. Now we can come up to the types of depository receipts. There are three main types: American depository receipt, European depository receipt, and the global depository receipts. So let's have an overview of these types. The first one is American depository receipts. So the American depository receipts are the negotiable security instruments which are issued by US bankers. As it is an American depository receipt, so this is also a negotiable instrument that are issued by the United States Bank, and it represents a specific number of shares that should be in a foreign company that is traded in the United States financial markets. American depository receipts pay dividends. So in return, receipts pay dividends in the US dollars and trade like regular shares of stock. And companies can purchase more and more stocks of foreign companies in bulk and reissue them in the US market. So the American depository receipts are listed in the New York Stock Exchange, NASDAQ, AMEX, and it can be sold over the counter at the same time at the counter place. So this are called American depository receipts. So before the introduction of American depository receipt in 1927, investors in the United States faced numerous issues when attempting to invest in the stock of foreign companies. So American investors could purchase the shares on an international exchange only, and they are mean to deal with the currency exchange rate and regulatory differences in the foreign jurisdiction. So if I'm in New York and I want to buy New York Stock Exchange, and if another province in the United States, let's say Colombia, so automatically we have to deal with the currency exchange rates and regulatory differences between both the provinces. So this is also the hurdle for the international investors as well. So they also needed to familiarize themselves about the different rules of different provinces, what would be the risks involved to invest in foreign companies, especially in the United States provinces, without a US presence. So, however, with the American depository receipts, investors can diversify their investments opportunities in foreign companies and without having to open up any foreign brokerage account. So automatically the US investors or international investors has to familiarize themselves with different rules and risks when they are willing to invest in companies without any presence in the US. So it is very important to understand about the rules and risks of different provinces in the US. Types of American depository receipt. There are two main types. The first one is sponsored American depository receipt, and the second one is the non-sponsored American depository receipts. So when we talk about the first type, foreign sponsored American depository receipt, in this particular type, the foreign company issuing shares to the public enters into an agreement with the US depository bank to sell its shares in the United States market, and that's called sponsored American depository receipt, where a foreign company issues shares to the public and enters into an agreement with the US bank and to sell its shares to the US market. So the US bank now, in this particular type, US bank is a more responsible for record keeping of sales, distribution of shares to the public, etc. Distribution of the dividend as well. So sponsored ADR can be listed on the United States stock exchanges like New York Stock Exchange, MX we can say, etc. Next one is non-sponsored American depository receipt. Under this type, it is created by a brokers or a dealers without any cooperation of the foreign company or banks who can issue the shares to the international investors. So here the brokers or the dealers is responsible for issuing the shares to the public. So non-sponsored American depository receipts are traded in the United States over-the-counter market without requiring any registration with the Securities and Exchange Commission. So there is no need to register themselves in SEC. They can easily buy the shares over the US over-the-counter market. So accordingly, they can buy and trade according to the requirements. So that's called a non-sponsored American depository receipt. So when we talk about the non-sponsored American depository receipts, so before 2008, any you can say brokers or dealers trading in American depository receipt were required to submit a written application before they allowed to trade into such market, US financial markets. And the 2008 Securities and SEC, Securities and Exchange Commission, amendment provided an exemption to foreign issuers that met certain regulatory conditions, and non-sponsored are only traded on over-the-counter markets. So there is a US counter markets where the institutional buyers or the dealers or the brokers can go there and trade. You can say their shares. So at the same time, they can enter into a market and immediately they can trade. How American depository receipts work. So investors who are willing to invest in American in ADR can purchase them from the brokers or the dealers, and the brokers and dealers obtain ADR by buying already issued American depository receipts on the US financial market. That means investors who are willing to invest, they have to purchase ADR from the brokers and dealers, and what the brokers and dealers do, they can obtain ADR by buying already issued ADR in the United States financial markets, or by creating a new ADR. So already issued ADR can be obtained from the New York Stock Exchange or the NASDAQ. So creating a new ADR involves buying of stocks in the foreign company in the issuer or home market. That means if I am the issuer, so in the foreign country, so definitely if I'm in US, so definitely US is my home country, and of course I could deal with the I could buy the stock of the foreign company in the issuer home market and depositing the acquired shares in the depository bank as well in the overseas market. So this is how the American ADR could work, and the bank then issue the ADR that are you can say equal to the value of the shares deposited with the bank. So whatever you have deposited with the bank, that decides your value of shares the depository bank could issue to you. So then accordingly the dealer and the broker take the ADR to the US financial market to sell them, and the decision is to create the ADR depends on the pricing, on the availability and the demand. So this is how the reissued ADR and the new ADR which is being created for the investors. Then investor who purchase the ADR, that is American depository receipt, are paid dividend in the US dollar, and the foreign bank pays dividend in a native currency, and the dealer and the broker distribute the dividends in US dollar only after factoring in currency conversion cost and foreign taxes, after facing off the currency conversion rates or foreign taxes. So such practice make it easy for the US investors to invest in a foreign company without worrying about the currency exchange rates. And the US bank that deal with the ADR requires the foreign companies to furnish them with their financial information so that the investor could take an appropriate decision for their investment and get to know about the company financial health. So this is a diagram which you can see a foreign company that deals with the American deposit receipts, and such companies could also pay the dividends in the US dollars to all the buyers who have bought shares from the foreign company. So every buyer, whether it would be 10 buyers, it would be 5 buyers, it could be 20, it could be 100, a foreign company pay dividends in the US dollar for you can say for buying you can say the American depository receipt, and the dividend would be in dollars to each of the buyers as well. So this is how the flow chart works in the whole mechanism of how, which showing that how the American depository receipt works. Now we can come up to the next important concept, the level of American depository receipt. The first one is sponsored level 1. Level 1 is the lowest level where the sponsored American deposit receipts can be issued. It is the most common level for foreign companies which do not qualify for the other levels or do not bond their securities listed in the United States stock exchanges. So that's called the sponsored level 1. And in this particular level 1, the companies are required to issue the shares quarterly or the annual reports like other publicly listed companies show publicly their reports. So level 1 issuers must have their stock listed on one or more exchanges in the country of origin. So level 1 can be upgraded to level 2 when the company is ready to sell through US exchanges only. Next is sponsored level 2 ADR. Level 2 ADR have more requirements. They have to follow up or they have to get an register to a Security and Exchange Commission than the level 1. So they have to follow the certain rules and deals with the trading. So definitely the company also gets an opportunity to establish a higher trading presence on the United States stock market, and accordingly they have to file a registration statement with the Security and Exchange Commission, which called SEC. And the company must file Form 20F in accordance with the GAAP or International Financial Reporting Standards, and Form 20F, which is equivalent to Form 10K, which is to be submitted by the United States publicly listed company. If the issuer fails to fulfill all of these requirements, then it would be downgraded to the lowest level, that is level 1. Next level is sponsored level 3 ADR. Level 3 ADR is the highest and the most prestigious level that a foreign company can sponsor. A foreign company at this level can float a public offering. They can offer a shares to the public of American depository receipts so that they can raise capital from American investors through the US exchanges. So level 3 is also attract the stricter regulations from the Security and Exchange Commission. And in this particular level, the company must file Form F1, that is prospectus, Form 20F, that is annual report, in accordance with the GAAP and the IFRS standards. Any material distributed to shareholders in the issuer home country must be submitted to the SEC as Form 6K. So if any company distributing any materials to the shareholders in the issuer home country, so if any member, like I'm an Indian, so if I you can say traded into a foreign company in the US foreign company, then definitely that company, the US company, has to distribute any of the material to the shareholders on my country, and that will also be submitted to the SEC and as Form K 6K. Examples of foreign companies that have managed to enter this ADR level include Vodafone, Petrobras, and the China Information Technology. Advantages: it gives access to foreign market. It is very convenient in the United States market, and of course the US investors can easily diversify their portfolio, their investment options to invest in the foreign companies and over a range of you can say industries. Liquidity: ADR are typically more liquid than any other foreign counter products or foreign instruments. They are traded in the major United States stock exchanges. Transparency is always be there because they are just disclose all of the strict requirements to all the US companies, which can provide, they can also provide investors with greater transparency and the information about the foreign company. Potential for higher returns. So investing in a foreign country leads to a higher returns. They have a potential to receive a higher returns as compared to investing only in domestic companies. Hedging opportunities are also there. ADR can provide investors with the plenty of opportunities to protect their you can say shares against the currency fluctuation risk through various financial instruments. Disadvantages of ADR. It is a currency risk, of course, always involved. As the currency rate fluctuates, it will impact the value of the investment. Market risk is also associated with these companies than the local markets. Fees is also been in terms of the higher taxes, higher fees as compared to the investing in the domestic companies. But in the foreign to invest into foreign companies leads to a depository fees, custody fees, foreign currency conversion fees always be there. So it could be quick higher. That also the one of the disadvantage of such receipts. Limited availability is also exist in the foreign to invest into a foreign countries. So sometimes ADR may not be available in all the foreign companies. So it's a limited availability. Lower dividend payout. ADR may have a lower dividend payout as compared to the foreign other companies. So of course it always subject to a dividend withhold taxes, because due to the taxes, higher taxes, they have the dividend with have to hold on in their home countries as well. Lack of voting rights. So ADR may or may not offer same voting rights as the foreign companies do offer. So of course they just limit the investors to influence over the foreign company. Regulatory differences also be there. So the foreign company must be subject to different regulatory framework, accounting statements, standards compared to US companies, which could make more difficult for US investors to evaluate the investment. So there are plenty of it. We can talk about European countries, we can talk about Asian countries, where the different accounting standards, regulatory frameworks differs from country to country, and in this way it is very difficult for the foreign investors to evaluate their investment. So this is also the one of the disadvantage. Next is, what is global depository receipt? Global depository receipt is a negotiable financial instrument which is issued by a depository bank and represent the shares of foreign company. So these certificates are being traded on the international stock exchange, excluding the United States, and allow the company from emerging markets like India so that they can raise capital from the global investors. So GDR determined in a foreign currencies, typically the currencies of the exchange where they can be listed, such as United States dollar or the euro. So this is also the one of the negotiable financial instrument, whereas same in the American depository receipt, which is issued by the depository bank that represent the shares of the foreign company, and the certificate is also being provided so that they can raise capital from global investors. So this is it is also the one of the sources of finance, or the one of the source to raise the capital from the foreign investors. For Indian companies, GDR are critical for assessing international capital market by listing their shares on foreign exchanges like London Stock Exchange and the Luxembourg Stock Exchange. The depository bank acts as an intermediary and holding an underlying shares and issuing GDR to investors. GDR in the stock market, so it represents the ownership of a specific number of shares in a foreign companies which is also not listed in the which is also listed on non-United States stock exchange like London Stock Exchange, Luxembourg, and the Singapore Stock Exchange. So they are traded independently. And one GDR represents multiple shares. So one GDR is equal to 10 shares through the ratios varies by company. So for Indian companies, GDR are the primary mechanism to list shares on the foreign exchange markets. So it excluding the US financial market where we have already spoken about the ADR. So GDR enable firms to attract the foreign investment without investors negotiate complex cross-border regulation, currency conversion or tax issues. GDR in the Indian market. So in October 2019, the Securities and Exchange Board of India, that is SEBI, introduces a comprehensive framework so that they can share the depository receipts including GDR, and they simply access to foreign capital Indian companies so that they can issue the GDR to the you can say to the public in India, and they can also offer the private placement or any other methods which is permitted to the target jurisdiction. The International Financial Services Center, that is IFSC in Gujarat, that is GIFT City, has emerged you can say hub of listing GDR. So it enables the Indian firms to raise their funds from funds through globally, and only the listed companies with regulatory approval from the Ministry of Finance and FIPB can also issue GDR. So this is how the Federation Indian Public Board can also issue GDR in such scenario. Examples of Indian companies with GDR include the UPL Limited, listed in the Singapore Stock Exchange, Aditya Birla Capital, listed on the Luxembourg Stock Exchange, GAIL India, listed on the London Stock Exchange. So this is how the Indian companies is also issuing the global depository receipt in foreign countries as well. Example of GDR issuance. So Wipro GDR in Singapore. Wipro deposits its equity shares and Singapore-based depository bank. So through the representing which issues GDR representing a fixed number of Wipro shares, and the investors in Singapore can trade these GDR on the Singapore Stock Exchange. So automatically when Wipro GDR in Singapore, then the Singapore companies or stock exchange and the GDR could you can say trade in the same stock exchange, and the cross market GDR use. An Indian company can also ADR can also with the ADR listed in the US can also issue GDR. So this is also the cross market GDR also. If any of the Indian company dealing with the ADR can also issue GDR. So these GDR denominated in euro are also traded on exchanges like the London Stock Exchange as well. So European investor can also access to the company shares too. Procedure for issuing GDR is a share issue, regulatory approval to be needed, custody and transfer fees is also being recorded in the company's books. GDR issue, when it is recorded in the company books, the overseas depository bank issues GDR in the foreign currencies which is listed and traded in the target stock exchange. Then the conversion and trading process would goes on within after a 45 days lock-in. GDR can be converted into underlying shares for trading into the domestic stock exchanges or sold back to the issuer. So this is how the GDR process, global depository process, goes on and ends with the issuing or after a locking 45 locking period. Advantages of GDR: it is a global investor access, it is a portfolio diversify, it can easily increase liquidity, is a very cost effective as well. Tax benefits is also available to all the investors, whether non-residents or residents in the foreign countries, and hence credibility. It also listed on the global platform, which increases the company reputation. No safeguarding fees, no fees to be you can say considered other cross-border custody fees or safe keeping charges as well. Disadvantages of: there's a high administrative cost. Maintaining and issuing of GDR is quite expensive for the companies. Low liquidity: GDR often trade in the institutional markets, is low liquidity as compared to the domestic markets. Economic risk is also there. Taxes and fees as deduction is always involved in it because of the international taxes or the currency conversion fees as well. Currency and political risk: the fluctuation in exchange rates or the political instability is also makes a handle in the issuer home country, could also impact the GDR value as well. This is also the one of the important aspect, the difference between the ADR and GDR. So American Depository Receipt is ADR and GDR is the Global Depository Receipt, where the American US Depository Bank is always exchanged the certain quantity of shares in the United States financial market, but automatically International Depository Bank will issue a tradable instrument called GDR, and it represents the shares of a foreign company and that are traded in the international market. So here in the American, we are dealing with the US financial market, and in the global depository market, where the shares of a foreign country, it's traded in the international market. GDR is negotiated anywhere around the globe, but ADR is only negotiated in America. American Stock Exchange is listed in for trading, but GDR is listed on a stock exchange outside the US. Next is Securities and Exchange Commission strict guidelines for the ADR disclosures, and GDR has a less stringent guidelines or disclosure obligations. ADR market is a market for the retail investors with the substantial investor activity, where a firm can share, where the firm shares are valued appropriately. But the market is institutional and less liquidity than the GDR, because GDR you can say GDR is actually the more liquid market when we talk about the investors' point of view as compared to ADR. So foreign currency convertible bonds is also be there, and where the convertible, it always convertible in nature. It indicates the investor not only receive principal and coupon payments, but also option to convert their bonds into stocks. So it is also the one of the instrument which is classified as a quasi debt instrument. So they allow both investor and corporation issues bonds so that they can share risk and reward as well, and that is a part of the foreign currency convertible bonds. So that's it for today. Thank you so much for listening this lecture. I will come up to a more and more interesting topic and important topics in the upcoming session. So till time, thank you and namaste to all.